accounting for subleases. This is something that was introduced to the SBR syllabus from the September 24 exam onwards. My name is Tom Clendon, and I help students pass the SBR exam. And what I want to do in this podcast is to talk to you about accounting for subleases. Now, before we get involved in subleases, I want first of all to do a very quick recap on IFRS 16. If I'm a lessee, when I enter into a lease, I will normally recognise both a right of use asset and an associated liability. Even though I won't have legal title to the asset, I will control it and I will have an obligation to make those lease payments. Now that's initially going to be recognised at the present value of the minimum lease payments. The asset might capitalise any transaction or dismantling costs. A lessee has a right of use asset and a liability. The asset will be depreciated and the liability will attract a finance cost. That liability will go up with that finance cost charged to the P&L and will go down with the cash repaid. So far, I probably haven't said anything too radical. Accounting for lessors is a little bit more tricky because a lessor has to work out what type of lease it has. So there's a classification process, and a lessor is somebody who owns the asset, so they have the legal title, but they are effectively renting it out to somebody else. So somebody else has got possession. Now, if the risks and rewards of ownership are passing to the lessee, the lessor will think of that as a finance lease and will not have the physical asset on its statement of financial position, because the asset that the lessor will have if it's a finance lease is basically a debtor, a net investment in the lease. Yeah, it will be owed money and it will be earning interest if it's a finance lease, if the risk and rewards of ownership have passed. But if the business is, Avis or a car hire business, the lessor isn't passing away the risk and rewards of ownership at that and under the lease. And therefore, the physical asset remains in the balance sheet, in the statement of financial position of the lessor. And the actual money that is being received, well, that's the income. Yeah, that's the revenue. That's what goes through profit. So I think it's important, first of all, to make sure that you understand how a lessee accounts for an asset, right of use, liability, how a lessor accounts for an asset, a lease agreement, depends on whether it's a finance lease, risk and rewards have passed, therefore you've got a net investment in the lease and you're recognizing income, or if it's an operating lease, you've got the physical asset in the balance sheet, in the statement of financial position, and you're recognizing through the P&L a rental income. Right, now I can talk about accounting for subleases. But before we talk about accounting for subleases, I need to tell you a little bit about my family tree. I am a father and my son is Alex. Alex is also a father and his son is Murray, which therefore makes me a grandfather. I want you to be Alex. I want us to think about Alex, who is in the middle, because Alex has a father and Alex has a son. Now, if Alex leases an asset from me, in this context, Alex is the lessee, so he will recognise a right of use asset. If Alex then leases that asset to Murray, then in addition to Alex being a lessee, Alex is now a lessor in respect of the same asset. And that's what we're talking about. That is the accounting for the sublease. all right, which is when Alex, who has leased an asset from me, is now leasing it onwards. So let's make up a very simple example. So Alex is leasing some office space for 5 years, and at the same time, it sublets all the office space on a 2-year lease. So it will regain possession of the premises in 2 years' time. Now, from Alex's perspective, Alex has got 2 things to account for. First of all, Alex is a lessee. You've rented it for 5 years. You recognize a right of use asset and therefore the depreciation through the P&L, and you recognize a lease liability and therefore finance costs through the P&L. As a lessor, we're subletting the asset for only 2 years. And therefore, in my judgment, substantially all the risk and rewards of ownership have not passed. And therefore, there's no derecognition of the original lease asset, and a rental income will flow through to the profit and loss account, when Murray effectively is paying the rent. That's the relatively straightforward example. I could complicate the example with a second scenario where Alex still leases the office space for 5 years, but 12 months later enters into a sublease for 4 years. Now, in that situation, the 4 years, 1 year after the 5-year lease has occurred, that represents the whole of the asset's life, and therefore Alex, as a lessor, has now entered into a finance lease. Alex, as a lessor, no longer has the risks and rewards of ownership of the asset. And therefore, Alex, as a lessor, would de-recognize the right of use asset, remove that right of use asset from the balance sheet, and recognize in its place a new asset, an investment in the finance lease, a financial asset. And the difference between the two would be an immediate profit or loss. Now, because Alex still has is still a lessee, there will still be a finance cost on the liability, but Alex is also a lessor, so will have a finance income going through the profit and loss account on the investment in the finance lease. I wish I could jump into your brain and show you all of the numbers, but this is a podcast. I've explained the ideas, and it may well be that in the exam you're explaining the ideas, or it may be there will be some simple numbers to manipulate. Thank you very much for listening. My name is Tom Clendon. I help students pass the SBR exam. Reach out to me on my WhatsApp 07725 350 793, or connect with me through my website www.tomclendon.co.uk. Find me on YouTube. I'm out there. Good luck.